Imagine building a company for 10 years, finally selling it for $100 million, and discovering that investors get paid before you do. In 2021, a rent-to-own startup called Divvy Homes announced it was being acquired for $1 billion. It sounded like the ultimate Silicon Valley victory. But behind the scenes, the terms of the deal meant that the common shareholders, the founders and the employees who built the company, reportedly walked away with absolutely nothing. We are conditioned to celebrate headline valuations. A large number implies success, market dominance, and personal wealth. But those press release numbers are public relations exercises. They do not dictate what actually ends up in a bank account. The public sees a single, massive number. The private reality exists on the capitalization table, a dense ledger of contracts where ownership is fractured, heavily conditional, and bound by strict legal hierarchies. When an acquisition clears, the cash doesn't just divide evenly among everyone who holds shares. The money is routed through a rigid set of rules determining who is legally entitled to take their cut first, and who takes whatever is left. The valuation gets the headline. The fine print dictates the economics. If you do not understand the terms of the deal, your payout might not survive the exit. The divide begins with the type of stock you hold. When founders incorporate a company and grant options to employees, they issue common stock. When venture capitalists write a check, they demand preferred stock. That preference is a legal shield against downside risk. The most powerful mechanism inside that shield is the liquidation preference. It determines the exact order in which proceeds are distributed during an exit. In a non-participating preference, the investor makes a choice at the exit. They can either take their original investment money back entirely, or they can convert their shares and take a standard percentage of the sale. They take whichever number is higher. A participating preference removes the choice entirely. It allows the investor to double dip. They get their original investment back off the top, and then they participate pro rata in whatever money remains alongside the common shareholders. To see how this breaks a company, consider a startup acquired for $20 million. Over the years, they raised 3 sequential rounds of funding: a seed round, a Series A, and a Series B. These preferences stack in reverse order. The Series B investors, the last ones to put money in, are first in line. They pull their entire protected amount out of the exit pool. Then the Series A investors take their cut. Finally, the seed investors pull theirs. The liquid value depletes rapidly. If the company exits below its peak valuation, that pool dries up completely before a single drop reaches the common shareholders at the bottom. Stacking participating preferences ensures that the people taking the biggest operational risks are the last to get paid. A moderate, stable acquisition becomes a zero-sum game for the builders. Long before an exit, founders surrender massive chunks of equity in the initial term sheet negotiations, often without realizing it. A few words dictate exactly how much of the company is sold. This starts with the valuation type. A pre-money valuation is the agreed worth of your business before the new investment check clears the bank. A post-money valuation is that pre-money value plus the amount raised. The post-money number dictates the investor's final ownership percentage of the new, larger company. The math is highly sensitive. If an investor quotes a $24 million valuation as a post-money figure instead of pre-money, the founder's slice shrinks noticeably. The investor secures 5% more of the company for the exact same check. Then comes a maneuver known as the option pool shuffle. Startups need an equity pool to hire employees. Investors know this and often require that the pool be carved entirely out of the pre-money valuation. The new shares come directly from your side of the ledger. You absorb 100% of the dilution, insulating the investor completely. This is just one of several silent diluters. Convertible notes stacking up with valuation caps and secondary share sales all act as hidden currents cutting away at the founder's eventual payout. When you combine heavy dilution with an artificially high headline valuation, the pressure spikes. The company is forced to take increasingly aggressive, unsustainable bets just to justify the inflated numbers to the next round of investors. These mathematical concessions compound. The founder gets trapped in a cycle of diminishing returns, agreeing to terms that erase their eventual payout years before the exit paperwork is ever drafted. Eventually, the math catches up. Founders reach the acquisition table and realize their piece of the pie is a paper illusion, which is locked behind layers of preferred protection. The core mistake is treating all equity as equal. Founders routinely look at the investor's share price and calculate their own net worth against that exact same number, assuming their common stock carries the same weight as preferred stock. It does not. As Peter Thiel once noted, a venture capital valuation is essentially a discounted bet on a future imaginary exit. It is forward-looking speculation, engineered to model a specific return on investment, not a measure of current tangible worth. Look at a 409A appraisal, the tax valuation used to price employee stock options. An independent firm will consistently value common stock at a fraction of the preferred share price, precisely because common stock lacks the liquidation preferences and anti-dilution armor that venture capitalists demand. Sophisticated founders stop asking, "How much is my company worth?" Instead, they ask, "How much will I actually own at the end?" Before you celebrate the valuation, understand the waterfall. Before your next investor conversation, don't just negotiate the valuation. Understand the ownership, the terms, and the story your numbers are telling. You don't need to buy anything to start asking those questions today. But if you're preparing to raise venture capital and want a structured system for building an investor-ready pitch, I've linked my complete $497 VC funding blueprint kit in the description. Inside, you'll get a VC-ready 16-slide pitch deck in Canva with tech-forward and clinical professional themes. You'll also get the AI Financial Narrative Engine, which takes 5 business numbers and turns them into investor-ready financial storytelling around LTV/CAC, ARR, runway, and more. There's a 16-page slide-by-slide VC instruction guide built around investor psychology, plus 16 VC-quality AI prompts, one for every slide. You also get a bonus 10-slide high-ticket B2B sales deck to help demonstrate early monetization. And the kit includes lifetime updates and full ownership, with 0 recurring fees. If you're serious about raising capital, the complete $497 VC funding blueprint kit is linked in the description. If this video helped you understand the side of fundraising founders often overlook, subscribe for more startup and VC breakdowns. So don't just build a valuable company. Make sure you understand who actually owns the value.